Okay, it's 12:30 and welcome to everybody for the latest in our Lunch and Learn webinars. The one today, as it says on the screen, is Knowing Your Numbers. So a big welcome to those who have been joining us regularly of these lunchtime learning webinars. Thank you for coming back again. And thank you very much for the people who are joining us for the very first time. The intention of these webinars is for people to get the most out of the time that we go through these. So we're going to be doing this for the next 30, 35, maybe 40 minutes. And much as though sometimes we are quite buoyant, we're bubbly, and we can't go through these quite quickly, today the one on knowing your numbers is going to be a little bit slower, a little bit more relaxed, because I want everybody to try and understand what we're going through. It's topic, it's a part of business that lots of business owners shy away from. So we encourage you to share your thinking or your learning as we progress through this session, and you can do that via the chat box. We have the team on hand who are monitoring everything going in there. It isn't compulsory, you don't have to use the chat box. I am going to ask a couple of questions and get you to use that as we go through and give us some thoughts and examples. The one thing I do encourage everybody to do when we're doing these webinars is please do make notes for things that you don't do currently that you can implement immediately when you go back to work. If there's something that you think, oh, the light bulbs come on, yes, we must do that, please do make notes. Let's make the hour very valuable and take the learners back and do something with them. Because, you know, if we've just helped with just one small thing today at lunchtime, it will have been a very good use of your time and indeed my time. Any questions as we go through, please do pop them through in the Q&A box. If I can cover them, I will. Otherwise, we will catch them up at the end. There are no silly questions. No questions are silly questions. The only silly questions are the ones that we don't ask that we really meant to ask. And everybody's here to learn, so don't hold back. It's actually okay not to know. So the more you participate, the more that you will get out of it. It's a difficult topic for a lot of people, and we're ambitiously going to try and cover quite a lot today, albeit at a more sedate pace, to try and get that learning across. Now, I understand that finances and knowing numbers and the application of them can be difficult. So if there is demand following this, we will put on a one-off workshop with a small fee attached if people need the practical help to go through. We can run those via Zoom, or as the world starts to open back up again from Monday, maybe in a workshop scenario. So anything we go through, if you haven't got it, please do write it down. So most businesses actually do have access to the numbers that they need. Their business will tell them everything that they need to know. Unfortunately, too many business owners and managers simply do not take the time to study them and understand them. Now, we see lots of things in business, and time being a constraint, because time takes up a lot of our headspace around what do we do, but yet understanding numbers is critical. One of the key reasons why businesses struggle is the lack of the application of numbers-based understanding in their decision making. I'll just say that again. One of the key reasons that businesses struggle is the lack of the application, or the lack of application of numbers-based understanding in their decision making. Could be the wrong numbers, it could be the wrong interpretation of numbers, but too often we see gut feel being used in decision making, and unfortunately these days, ever more so these days, that the margins are so tight in many industries, so tight that there's very little scope for error. And I'm going to work through an example later on that shows the difference between margins and why it's critical that we understand them. Now, you look at businesses that start up, and I appreciate that the people who are on the webinar today are of different levels of maturity in their businesses. Some may be a year old, some may be 3, some may be 5. We may have businesses 10, 15, 20 years old. I'm going to talk specifically about businesses that have started up and the survival rate in the first 5 years. Now, you may know these numbers, but I'm just going to reinforce them such that we don't lose sight of how difficult it is to build or to start a business, build it and get it established. If we were starting a business today, the statistics tell us that in 5 years' time, 80% of those businesses will have failed. For one reason or another, 80% of those businesses will have failed. So only 20% survive to year 5. And from year 5, of those 20% that survive, 80% of that 20% are no longer in existence by the time we get to year 10. So if you work those numbers through, from starting today, only 4% of businesses will still be in existence in 10 years' time. And there are lots of reasons why business struggle, and there's lots of reasons why we have business failures. But as professional business coaches, what we see across the UK is the ones that have struggled, it's not understanding numbers. It's not understanding those numbers. So if you look at ourselves as human beings and who looks after us, well, it's quite clearly it's our doctor. And our doctor will look at our physical health by tracking a few important numbers. Now, it doesn't matter whether they're talking to John or whether they're talking to any of you guys and girls that will be on the webinar this afternoon, but they're only interested in a few numbers. And those few numbers will tell the doctor whether or not we are in control or not. So heart rate, blood pressure, body temperature, if they need to dig a bit deeper, they will do, but they're the most important numbers. That will tell them whether or not that person is functioning properly or pretty much optimally. So what are the vital signs for your business? So let's think about it and put it in a business context sense now. We own businesses, we're running these things. So what are the vital signs for your business? If you were on a beach now running your own business, what 2 or 3 measures would you want to keep an eye on? So if you were running your business from the beach, what 2 or 3 measures would you want to keep an eye on? Use the chat box. Let's get some ideas and see what do you think of the things that are important. So if we're running our business from the beach or from the Bahamas or wherever we are, what 2 or 3 numbers do you think you would want to keep an eye on? So let's just fill that chat box with some answers. Let's get a little bit of feedback. Let's get a little bit of interaction. As I said earlier, there are no wrong answers. So what do you think we should be looking at if we're trying to run our business from the beach? No wrong answers, please do. So starting to come in already. So the cash position, our sales, our income, our expenditure, absolutely the tide. If I'm running my business from the beach, I need to know what the tide times. Absolutely, yeah, that's brilliant. Turnover, margins, cash flow. So interestingly, lots of different answers coming through. And as we said, there are no wrong answers. So if we think they're the things that we should be measuring, the next question to pose to all of you guys is, what are the benefits of knowing your numbers? So we think now we know what we want to measure. What is the benefit of knowing those numbers? So if we're managing remotely, we're watching the tide very closely, sat on the beach, and we want to know the numbers. We've decided what we're going to measure. What are the benefits? Again, use the chat box. What are the benefits of knowing your numbers? What would it mean to you as the business owner if you knew you had those numbers? What are the benefits? Again, use the chat box. We'll have a look, see what people are putting in. Again, no wrong answers. So what's the benefits of knowing those numbers? Brilliant, Gary. Calmness through knowledge, or in brackets there, or panic in capital letters if the numbers are not where you want them to be. Absolutely, that would be a benefit of knowing what's going on. Knowing what your spend budget is. Now, budgets are interesting. We're going to cover budgets and forecasts a little later. Are all the actions that we're doing resulting in success? Brilliant question. That's the one thing we want to understand. What is success? What does it look like? We're identifying our sales targets. Yes, we are. Not only have we hit our target, not only have we put our targets in place, we know whether actually we're hitting them too. So all of those things, absolutely correct. Now, if you were to look at it a little bit deeper and say, so actually, much as though human beings, you can see if those 3 things were in good order, then obviously we are living, we are healthy. For our businesses, what does it particularly mean? Well, understanding your numbers leads to these things here. So I will read them out. It means to tie to financial control. Is that a good thing for our businesses? And the answer to that is we know that absolutely is. So we know that things are under control. We make better business decisions. We make better business decisions because we understand what the numbers are, and we understand that we are in control. It immediately gives us a great awareness of risks and opportunities. So the answer previously that said calmness or panic, we understand what's happening because we can see we've got much bigger awareness. Proper examination of issues. Once you start to see things that are drifting away from where we wanted them to be, we can actually start to look at that and say, okay, what do we need to do differently? So the business is telling us that things are starting to move in a wrongwards direction. So we can really have a forensic look at that and say, what do we need to do? Effective invoicing, collection and payment. This is one of the things as you grow a business that sometimes gets neglected or often gets neglected to the point that we think people are going to pay us. We're going to talk about how people pay us a little later. And better cash flow management. And anybody that's ever done any work with me will understand or know that one of the things that I really like to see is a 6 to 12 month cash flow forecast for every single business, because I want to understand the cash position. It's the very heartbeat. So at the bottom there it says keeping your business alive. That's exactly what it is when the doctor's looking for those important measures for us when we go to see him. We're looking at businesses and we're looking for the numbers that are important to keep that business alive. So what is it about business numbers that we need to start looking at and recognize? Well, the first thing about numbers is, they are black and white. It takes out any anecdotal evidence, gut feel, etc., etc. Also, all those soft issues, they've gone. It's very binary. It's either correct or it isn't, or it's moving in the right direction or it isn't. Numbers are a global language. It doesn't matter whether your business is in the UK, whether you're trading with people overseas, etc. It's a global language. The terms and the terminology are pretty standard. There are a few anomalies, but pretty standard. It allows us to communicate with our business. More importantly, our business is communicating with us at all times and telling us what's happening. We just have to recognize what it's telling us and actually do something with it. And in terms of where we're going, every single business is in business to make profit. Now, in the UK, people see profit as a kind of dirty word. Well, across the Atlantic, and they don't find it a dirty word across in the States, and it shouldn't be in the UK. Profit is something that we have to generate when we're running our businesses. Profit allows us to reinvest and grow still further. It allows us to reinvest in people, allows us to reinvest in capital and plant, etc., etc. So profit is absolutely critical, but cash is the thing that keeps every business going. And you would look at a profit and loss account in any given year, which might look particularly dreadful. A profit and loss account will never or very rarely take a business down. The reason businesses, a lot of cases, cease to exist is because of a lack of cash or they've run out of cash. So we are going to talk a little bit about cash. So we're going to look at the key financial reports, of which there are 5. So we're going to talk about the profit and loss statement first. So what is a profit and loss statement? I mean, profit and loss statement, it's simply an accounting term for the story of your business's trading during a given period of time. Could be a week, could be a month, could be 6 months, could be a year. P&Ls, we encourage every business to have them on a monthly basis. It's the story of what's happened during that last period, and it shows your business's income. Your income comes from sales, from bank interest and other income, less the expenses. It is really as simple as that. So P&Ls really shouldn't be any more difficult than looking at these 5 things here that says, okay, what were our sales, revenues, turnover? 3 things, 3 different names, all exactly the same thing. So what were our sales? What was the cost of our sales? So the COGS is the cost of goods sold. So the things that we sold, how much did it cost us to have them? So sales minus cost of goods sold gives us our gross profit, or gross margin, as some people would call it, if you put it in percentage terms. And then you've got all your fixed costs that are there regardless of whether or not we are there or not. And that taken off gives us our net profit. So profit and loss account is, what did we sell? How much did it cost to buy the stuff that we sell? That's our gross profit. Oh, we need to take off all the other costs. And then we're left with our net profit at the very bottom. So what are those differences between the fixed and variable expenses? So again, let's use the chat box. Let's have a look and say, so what are examples of fixed costs? So what fixed costs do you have in your business, or what fixed costs do we see that are common across many businesses? So let's use the chat box. Let's get some interaction going here, and let's have a look at what people believe are fixed costs in their businesses. So rent, insurance, mobile phones, broadband, membership fees, rent and rates, all very good examples. Any others? Any others? As we said at the beginning, there are no incorrect answers here. So what are all these fixed costs that we've got? So software, absolutely. So we look at all of those fixed costs, and then we start to look at variable costs. So what do we believe variable subscriptions as well, Gary? Absolutely correct. So what do we believe variable costs are? So what examples do we have of variable costs? Again, use the chat box. Let's have a look and see what we've got for variable costs. Travel expenses. The could actually be a variable cost. So what we're seeing already is purchases. All right, we're starting to get some answers coming through now. When we start to ask the question in and around what's a fixed and a variable cost, the first thing is that people start to recognize is, or realize, is that I'm not quite sure what the difference between a fixed and a variable cost is, or a fixed or variable expense is. So very simple terminology. A fixed expense is something that's incurred whether or not you have any sales. So the very fact you've got your business and it's there, you will be paying this money out regardless of whether or not you sell anything. Variable expenses, they've incurred because you do have sales. So if you are a product-based business, the biggest variable cost that you have got is the cost of the goods that you've sold, because you've had to buy them. All the other expenses, rent, rates, salaries, bonuses, etc., etc., etc. Maybe not bonuses if you're not selling, but all those things that are there, salaries, etc., insurances, that you're going to have to pay those out whether or not you've sold anything or not. So they're fixed expenses, and they will be there month after month after month. The variable expenses then go on top of that to give us our total cost. So you start to understand that. All right, okay, I'm starting to understand what these two differences are. Your accountant's very interested in them because they want to talk to you around what that means to you at the end of your financial year. Sorry. So I'm going to move on now to the balance sheet. And the balance sheet is something that, in our experience, very, very, very few business owners look at. They will look at the P&L, because what they want to do is they want to go and have a look at it and just say, right, okay, how much money do I make? How much tax do I have to pay? Yep. Sometimes that's as much as we hear. Right, show me the P&L. What do we make? How much tax do I have to pay? The profit and loss will tell you much, much, much more than that. But the one thing they'll never look for is, I've never heard any business owner say to me, oh, have you seen my latest balance sheet? It looks amazing. So we shy away from the balance sheet. Why do we shy away? Well, mostly because we don't understand what the balance sheet is there for. So it is the least understood of all the financial things that we have. But actually, along with the P&L, it's one of the two most important. It provides a snapshot of the overall health of the business. So much as a P&L will give you information that relates to a period that's just preceded the publication of the P&L, the balance sheet will give you information on that particular, at that time that you produce the balance sheet, it is bang up to date. It's called a balance sheet because it balances assets with liabilities, and it also includes any equity that might be in there. It represents the overall financial worth of the business. And if you're looking at values, and if you are starting to look at exit strategies with your business, or you're starting to prepare for what might happen 3, 5, 10 years down the line, you start to really look at about what is the worth and what is the value of my business. And a balance sheet will, once at the point of completion, will show you what the value of that thing is for the day. There are three, essentially, trying to keep it in its simplest form, because what I don't want to do is overwhelm people with financial things today, because I understand and recognize that this is one of the hardest parts that a business owner has to get their head around. But there are three key parts to a balance sheet. You've got the assets. Assets are the things of value that you own, which could be plant, land, equipment. Got land twice there, you must have lots of land. So plant, land, equipment, and cash. It looks at the liabilities. This is what you owe to people, either in loans or overdrafts or accounts payable. And it looks at the equity or net worth. And this is the owner's stake in the business. So whatever capital shares, retained earnings. And you look at this, and certainly, as I said earlier, as you start to prepare and you look for sale, that bottom one becomes ever more important. So understanding what a balance sheet is telling you and the strength of your balance sheet will give you a very good indicator of actually what the strength of your business is. So we're going to move on to the cash flow forecast. So many people will have seen this previously. Turnover is vanity, profit is sanity, and cash is reality. Now, I would just add one extra to that. So I would always add that one to this one. Value. Value is the outcome, or value is your future. You will exit your business at some point, either voluntarily or involuntarily. You will exit your business. What is the value? What is your future looking like? What is your business telling you? So just coming back to that cash one and starting to realize that cash is the oil that makes your business makes it flow. I mean, cash flow is the money that's moving, i.e. flowing in and out of your business in a month, in a week, in however you want to measure it. And I get that. Certainly in the early days of running a business, it seems that cash flow only goes one way, but actually it does go both ways. As you start to establish yourself, believe me, cash flow does go both ways. So what goes into a cash flow? So 4 main things that go into cash flow. We're going to use the chat box again. So actually, where does your cash come from? So we're all running businesses. You guys are all business owners. You guys and girls are all business owners. Where does your cash come from? 4 main areas. Let's use the chat box and see if we can cover off all 4. Where does our cash come from? Brilliant. Some answers coming in already. So it comes from sales. It comes from investments. Yeah. It comes from our customers. Absolutely does. Yeah. It comes from our subcontractor. Where else does it come from? It comes from residual income that we've got. Brilliant. Any more answers in there? Where does our cash come from into our business? Now, this is vital to understand because actually we want to get more and more cash into our business. So, where does it come from? It comes from the bank. It absolutely does come from the bank. So I think we've probably covered off most of the 4 or all 4 areas where it comes from. So let's have a quick look at what those 4 areas are. So it comes from income generated by the business, sales. So we get that. It can come from the bank in terms of borrowings. So we could sell something, or we could actually have a capital injection from monies that we hold ourselves or have been given to us by other people. So they're the 4 main areas where the cash comes from. Now, similarly, where does our cash go? Who is taking all of our money, our very hard-earned money that we've strived to get our product or service to marketplace, and then all of a sudden, all our money starts to disappear? So again, use the chat box. Where are the 5 main cash drains? Where does our money go to? Who's taking all of our money? I don't know if everybody can see the chat box, but the first one says my wife. Salaries, absolutely. Variable costs, fixed costs, taxes, debts, rent, utilities, brilliant. Employees, marketing fees, taxation, yeah, brilliant. All of those places. So I think we've already covered off probably all 5. So let's have a quick look at what they are. So that's pretty much what we said there. So general expenses and overheads, including taxes, those things are going to be there all the time. Once we start to run our businesses, those things are never going to disappear. If we're mostly in a product-based business, then we're going to have to purchase stock. So the cash goes out, cost of goods sold, absolutely. If we are starting to look at relocate or buy things, then fixed assets, we have to pay back any money that we have borrowed to start with. And most importantly and most vitally, we have to pay ourselves. We have to pay ourselves. We do deserve, some outcome from actually running a business. So actually paying ourselves is something that's vitally important. So we've got to include all of those things into our cash flow. So we start to look at a picture of money that's coming in and money that's going out. And you can look at the things, in and out, and look at your overall cash position to see what actually happens. Now, there is an issue which we need to talk through, which we call the cash gap. Now, this is mostly for a product-based business, but not necessarily. So I just want to talk through this diagram here, just to try and get across the concept of what the cash gap is. The cash gap from left to right means we've paid cash out and we're not getting any cash back until the right-hand side. So on the left-hand side, we've paid out, we're not getting cash back. How does that happen? So stock arrives here. So once it gets here, we have to actually start paying for that stock that's arrived, and we may have up to 30 days to pay for it. We may have up to 30 days, but we have to pay for it. No one's going to give it to us for free, and no one's going to give it to us and let us hold it and not pay for it until we use it. That's very, very, very rare occurrence. It does happen in some instances, but it's very rare. So we have to actually start paying for this stock. Now, are we going to sell that stock immediately? And the answer to that is we'd love to, but actually we end up holding up to quite a lot of it. And then when we have sold it, we may give people up to 60 days to pay us. We may give them up to 60 days to pay us. And if they take that full 60 days and we haven't sold it until here, what's actually happened here is that's 120 days from receiving the stock before we get paid for it. That's 4 months. 4 months. In the first 30 days, i.e. the first month, we've had to pay for all of that stock, and we may not receive some of that to 120 days. That means we are funding that cash gap over 90 days. Not to have that cash in our businesses when we've got all of those drains that's taking our cash. We need our cash in as quickly as possible. So you start to look at, whoa, crikey, that I need to reduce the amount of days between 0 and 120 so I can get my cash in quicker. And the answer to that is, yes, we do. Understanding your cash gap and how big it is vital to start to understand, can we actually start to bring it down? So what I want to do is look at, how do we reduce that cash gap? I'll just go back once more and just show it again. So the stock comes in, we have to pay for it in 30 days. We may not sell it until day 60, at which point someone decides they're going to take 60 days before they pay us. That's a long time not to have money for stuff that we've already bought. So use the chat box and list anything that you can think of that will actually reduce the length of that cash gap, because that's pretty important for us as business owners that we don't get it. So use the chat box. What can we do to reduce the length of that cash gap? Go back to the beginning. There are no wrong answers. Just throw anything out that you think would work. And just to give you a little flavor of what's going to happen after you've used the chat box, I'm going to show you 16 strategies that may reduce the length of that cash gap. So there are many things to go at. So let's throw them in the chat box, ladies and gents. Brilliant. Starting to get some answers coming in here. So longer terms from your suppliers, shorter terms for your customers. Absolutely. Absolutely shorten those terms to your customers. If you're giving them 60 days, start to bring it down to 45 or 30. Just in time stock management. Brilliant. The whole of the automotive industry works on JIT stock management. It has to be very efficient for it to work, but it can. Partial payments up front. Brilliant. Starting to get people to pay you a little bit more before, trimming the process to be as lean as possible. Also, brilliant. All of those things that start to shave any days or weeks off that process is brilliant. So things like paying up front, cash on delivery, fixed monthly fees, all of those things. Excellent, excellent. And if I was to give you 10, 15 minutes to come up with some others, between you, you would probably come up with many, 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 many more. But actually what we should recognize is it's vital. It's vital that we close that gap as much as we can. So invoice financing, brilliant. Yes, you could do that if you wanted to do it. And indeed, lots of businesses do. Factoring, as other people would call that. Discount stock that's not selling to get it out and get some cash, get some pound notes in. Absolutely, yes. So what is your stock turn, if that is something that you measure? So brilliant. We've clearly got some product-based businesses, I would suggest, on the webinar this afternoon. So let's have a look at some of these strategies that you could use. If any of these are important to you, please, please, please write them down. Write them down and take them away with you so you can actually start using them. So some of these you've already covered. So take partial or full deposit on a contract to be paid up front, so we're getting our cash. Brilliant. Once projects are finished, get them done so they can get billed and invoiced. If the part finished, see if you can part finish and part bill and part invoice. Invoice immediately on completion of the job, immediately. Now, for anybody that wasn't on a previous webinar that we ran, when you raise an invoice, the law of the land in the UK is that is payable on raising of invoice. Yeah, I said that. What I just said there was absolutely what I said. I'll just say that again. When you raise an invoice, the law of the land in the UK is once it's raised, it is payable immediately on the raising of the invoice. Now, you'll tell me some people don't pay me for 30 or 60 days, John. That is against what the law of the land is, and mostly because people have decided they'll put T's and C's in place that says, oh, we'll give them 7, 14, 30 days to pay. You don't have to do that. We've chosen to do that with our terms and conditions. The law of the land is invoices are payable as soon as they are raised. So the 30 days, the 45 days, the 60 days, if that's you and you've put that into your processes, cut it out immediately. Use a delivery and acceptance process at job completion. Brilliant. Systemize the billing and invoice process such that once things are finished, it automatically happens and goes out without you having to do anything else. Where there is manual intervention invariably means there are delays. Is there something you can do to speed that process up? Complete your billing and invoice on a weekly basis. So even if it's a job that might be lasting a month, 2 months, bill and invoice on a weekly basis. Or in the general running of your business, don't just do everything on a monthly basis, do it on a weekly basis. It will improve your cash flow. As it says there, give 7-day terms instead of 30. That's our choice. That is our choice. And once you've sent someone an invoice, don't worry about sending multiple invoices. Send them an invoice at 7 days, at 14 days, at 30 days, and 45 days. You've already provided the product or service that they've taken. In terms of the general exchange of goods, then they have to pay you what the market value was or what you'd agreed. So they've already had it. So don't ever feel embarrassed about sending out or resending out demands at 14, 30, and 45 days. You've been good enough to provide the product or the service. They should be good enough to pay you. And if you want to give a discount for early payment, it does encourage some people to do that. And people will pay you earlier just to get that discount. If you've got a £1 million business and you pay everything early and you get a 5% discount, that's £50,000 in your back pocket. Yeah, that's the difference it makes. It's huge when you start to work it through. Add and collect interest on overdue accounts. That's perfectly permissible under UK law. If you want to, one of the guys or girls in the chat box put this one in, outsource the entire billing invoice process. Get someone to do it on your behalf. Invoice factoring, as it's called. So if any of these are relevant to you, please do write these down and take them away and start to use them. And for the person that put just-in-time delivery, there it is. That is absolutely one of the things that would lower that cash gap. If you can, buy your inventory on consignment and pay it when it's sold. Some people may do that, but what I do know is if you don't ask the question, we will never know. Negotiate the price on larger orders, but receive and pay for entry on a gradual flow. So again, it's all for us. It's to the advantage of us. Negotiate longer terms from your vendors and then use progress payments on projects. So a lot of those you guys have covered during, in the chat box. But when you actually start to think about it and we say, right, oh, actually, some of those things would work for us. If they would work for us, please do write it down. Take it away and do something different in your business. These are lunch and learn webinars. And if we're learning something, let's take it back and let's get the learning, into our systems and processes. So cash flow reports. Now, I could have given you many examples of a cash flow report. So we've just got a 6-month cash flow report here. We've got our sales, we've got our cost of goods sold, we've got our gross profit, we've got some expenses and overheads and fixed costs, we've got the salary of the owner, net profit, a bit of cash injection, and the cash position at the bottom. Now, once you understand how these things work and you are projecting forward, the first thing anybody looking at this would say, right, actually, we've got a bit of a problem here, haven't we, John, in month 4 and month 5, or month 3, month 4? And the answer to that is, yeah, on the face of it, yes, we absolutely do, because sales have dropped. The gross profits dropped, our fixed costs obviously don't change much, and we're still taking our money out. And you can see in month 2, net profit starts to deteriorate. In month 3, it deteriorates quite badly, the net profit. And in month 4, it's still negative. Now, the interesting thing is you would have thought month 4 that the net profit was way lower, still less than negative, but much less than month 3. So you would have thought that the cash position would be so much better. But look at the cash position. Look at the cash position. This is the thing that we need to keep our business afloat, the cash. Look at the impact of what's happening with this cash flow forecast. So when we look at that, what are the 1 or 2 things that we should be doing differently to make sure we don't get into a position in month 4 where we are minus £10,000 in cash? Use the chat box. What are some of the things that we could do to prevent that position from arising? So use the chat box. What could we do differently now that we can see it? How could we stave that off? Because in month 5, we're having to put a cash injection of £5,000 in. So what could we do? What things could we do to stop us going into a very, very serious cash position like we can see in months 3 and months 4? Again, use the chat box. No wrong answers. Interesting. So it's taken a little bit longer to start to look at what the answers might be. So it's a little bit more consideration of what we could do. So we could add a quick pay service. Yes, we absolutely could. Yep. Again, keep firing them in. There are no wrong answers. So we're looking at this overall situation and saying, what do we need to do? What would this business need to do differently? Now, the fact that it's taken a little bit longer for people to put things into the chat box is good news, because actually what it's saying is I'm having to seriously think about my business here and what do I need to do differently. So I need to reduce my costs, both of them, fixed and variable if possible. Absolutely, we would look at that. We've got to increase our sales. Wow, if we increased our sales in month 3 from 50,000 to 75,000, would it make a big difference? And the answer to that is actually that would make a huge difference. So if we work that through and say, what else could we do? We're looking at 3 months hence, and because the cash flow forecast is telling us this, we now know from a marketing perspective that it is usually a 3-month lag between starting marketing and seeing the impact in our sales line. We know we need to get more sales in month 3, preferably in month 2, month 3, and month 4. So we need to do something differently to increase our sales. We might want to start a marketing campaign, or as somebody else has put in the chat box, we may need to go and get a short-term loan or increase our overdraft. Again, they would do them. The great thing is our business is telling us in a few months' time we've got a bit of a problem. We are not waiting. We are being proactive by having a cash flow forecast in place that we know this is going to happen. We are ready, we are prepared, we can do something about it. It's still not palatable, I understand that, but we can see it, we know what's going to happen, we need to do something different. The power of a cash flow forecast is immeasurable. That's why we prefer to see businesses with at least a 6-month cash flow forecast, if not 12 months, so we can see what the impact of what's going to happen if things stay as we know what they currently are and what we will need to do differently. So, budgets and forecasts. Budgets and forecasts, completely different things. Budgets are things that you put in place and say, I'm going to budget spending £10,000 this year on marketing. So I've now got a marketing budget. Now, most businesses already have a marketing budget. They just don't know what it is. Because if I say to businesses, are you spending money on marketing? And they'll say, no. Well, we are a bit, yeah. Well, how much? I've got no idea. Well, what about if you just took a number like 10% of your revenue and spent it on your marketing? What would that do for you? Oh, I'm not quite sure I want to spend 10% on marketing, John. Really interesting, because when you start to look at businesses and work out actually how much they are spending on marketing, it's not unknown for it to be in and around the 10% mark. So if we know that, and if we know we've got a forecast of turning over £1 million, 10% of that 100,000, let's have a £100,000 marketing budget. Oh, that's way too much, John, because actually what we're doing is we are declaring what we are going to spend up front. We can then budget each month. If it's 100,000, we can spend £8,500 every month on marketing, and we've already budgeted for it. We know we've budgeted it, and we can spend it because we've already allocated it in our forward-looking cash flow forecast. So the cash flow tells you what you can spend and when. It also has the added advantage of telling you when you're going to get paid. So those forecasts should be in place. Budgets. Once you put the budgets in place and you can allocate them on a monthly basis, put those monthly amounts into your cash flow forecast and you can see when they're going to go out. Add them to it. So your budget is an amount of money that you are telling yourself you can spend. That's okay. Stick it into your forecast. Forecasts are for looking at things on a forward-looking basis. Now, in terms of starting to put your stuff into the marketplace and sell it, I just do want to cover off this thing called markup versus margin, because this confuses a lot of business owners, certainly in the early days when they start working out what they're doing with the business. And it's vitally important when you start to look at putting your prices up and discounting, which I'm going to cover very shortly. So if we've got something that costs us £100 to buy and we're going to sell it for £125, the profit is 25. And because it's a simple illustration here, it's 25%. So it costs £100, we're going to sell it for 125. Therefore, we've made £25, which is 25% of 100. So if we've sold something for £125 and we know we've marked it up by £25, what's the margin? And most people think the margin is 25%, but it's not. It's not. This is the difference. We've sold for £125. Of that £125, 25% of it was profit. Sorry, 25 of the 125 was profit, i.e. 1/5. So 1/5 of that is the margin we're making on the £125. So actually what we're making, 1/5 is 20%. So I'll just go through that again. £25 of £125 is the margin. That's the margin that we've made. So the margin, 25 out of 125, which is 1/5, which is 20%. We've marked it up by 25% because we bought for £100 and we've sold for 125, so we've made a profit of 25%. But of the overall £125, that £25 profit is a 20% margin because it's 20% of 125. Now, understanding what your margins are becomes vitally important when you start to look at discounting, if you want to discount, or increasing your prices. So just very quickly, terminology, then I get onto the discounting. Markup's an amount added to the price of something. So it's the difference between the cost of producing something and its selling price. In that example, £100, we made it £125. So if you buy for £100, if in this example, the markup's 50%, you're going to sell it for £150, your profit is £50. That's markup. Markup is usually quite easy for people to understand. Margin is the difference which exists between the net sales and the cost of the merchandise sold. Now, I don't want to get bogged down in terminology. I just want to get people to understand that if we're buying for £100 and we're selling for £200 because we want the margin to be 50%, we have to sell for £200 to keep the margin at 50%. So the profit here is £100, but the margin is 50%. So the difference between markup and margins, and when we do practical examples with people, the penny starts to drop a little better, but we have to understand what the difference in margins are, because if we're going to start looking at discounting, and as professional business coaches, we really do try to steer people away from discounting at any point in time, purely because it costs you or has the ability to cost you a lot of money. So on this chart here, if your present margin, because we understand margins, it's any of those numbers across the top. There are tables available with smaller ones too. And we decide that we're going to discount our price by one of these numbers here. These numbers here tell you by how much your sales must increase to keep the same margin, to keep the same revenues coming into your business. So let's have a quick look at the example here, 30% margin, and we're going to discount our price by 20%. We have to increase our sales by 200% to have no impact on our bottom line. We have to double the amount we are selling to have no impact to our bottom line. Now, when we talk to most businesses and saying, what can you do to double your sales? They'll look at us and say, well, if we knew that, we'd be doing it already, John. Excuse me. Well, what about the times when you've discounted in times past? How often have you doubled your sales? Well, never. Oh, let's just have a look at the impact. If you're on 30% margin and you discount by 20%, you have to double to have no impact on your bottom line. That's a lot of work that you have to do, if indeed you can actually do that. Discounting your prices has the ability to cost you a lot of money if you don't understand what the impact is. So every time we work with someone and they're talking about discounting, the only question we ask is, so show me the impact, show me the impact. And if they can't show us the impact, we know that they're not comfortable or they don't know the numbers. If they're not comfortable and they don't know the numbers, the advice immediately is do not do any discounting until you understand what the impact is, because otherwise it's like having your head in the sand and you're just thinking it's going to be okay. The only thing that it will do from a positive perspective is bring cash back into your business. It may not be enough cash to cover the cost of the stuff that you've bought, but it will bring cash. It is a cash injection. Unless you can double the amount of sales you've got in this particular example here, it is going to impact your bottom line massively. Similarly, and in reverse, if you increase your prices, if you know your present margin is any of those across the top, and you look to increase your prices here, this is one of the things that business owners really struggle with. Oh, if I put my prices up, I'll lose all of my custom. No, you won't. No, you won't. There is a chance that you may lose some of your custom. You may lose some of your custom. So let's have a look at an example here. So 30% margin, and we're going to put our prices up by 20%. Oh, John, we can't do that. Well, your sales would have to decrease by 40% to have an impact on your bottom line. They would have to decrease by 40% before you saw an impact on your bottom line. So if your margins is 30% because you know that, because you measure it, and you put your prices up by 20%, you would have to lose 40% of your sales or your customer base before you saw an impact. Now, most people think about that, that can't be true. Well, it is mathematics. So even if you look at one that's 10%, if you know your margins are 30% and you put your prices up by 10%, you'd have to lose a quarter of your sales before you saw an impact on your bottom line. This is all by understanding the numbers in our businesses and seeing what the business is telling us. So yes, numbers are very important. The last one here, sorry. So we've done the P&L, balance sheet, the cash flow, budgets and break even. Let's have a look at the key performance indicators, KPIs, the things that we think that we should be measuring. So what are the numbers that we should be measuring? So the question at the start was, if you were on the beach, what would you measure? I'll never forget now. Every time I do this presentation, I'll be talking about tide times, because that's just a genius answer. So thank you, whoever put that one in. But your business vital signs. What were the things that we need to measure? So here are some examples. We are not saying that these things, the ones that you have to measure, these are just there just to prompt you and just say, are these things that you think you should? If they are, please, again, write them down, take it away and say, I need to start measuring this in my business. So in terms of the financials, are my sales increasing? Am I making money? More importantly, what does my cash flow look like? Do I have enough in my business to be able to meet my obligations moving forward? Am I losing or gaining value? And what ratios do I need to look at? Now, I've steered away from ratios this afternoon because this is not a finance masterclass. It's just about understanding our numbers. And there will be some non-financial KPIs that you will want to have as well. And they can be anything you want them to be. The only advice we give when you're putting key performance indicators in place is they have to be relevant. They have to be relevant. We don't put them in just for putting them in's sake. So financial and non-financial KPIs. Now, I'm going to finish by giving you my top tip for day-to-day running of your business by saying you should have 4 bank accounts in your business. And immediately most people will be freaked out thinking, oh my goodness, I only have 1. Some people have 2. The odd business has 3. So 3 or 4. We would recommend 4. We would recommend a minimum of 3. What do we need these bank accounts for? Well, you've got your current business accounts. So, excuse me. This is the one that you're using for every day-to-day payments. If you're running an overdraft on it, every month it should return to 0. If not, we've got an issue. We're not running it well enough. There's something not quite going right. So if you're running an overdraft, it must return to 0 monthly. In an ideal world, it would be just above 0. So everything's coming in, going out, and we stay just above 0, but it's there, it's bubbling around that number. If not, start to look at restructuring whatever debt you've got into cheaper, predictable loans and reduce the number of outgoings that you've got. We always say beware the factoring invoice discounting trap, because other people will do the invoicing for you, but it will cost you and you do have to pay them, and people forget that that cost is going to come in, and sometimes it's phased or staged and we don't always get it. And the bit at the bottom that says there's no substitute for taking control of risk management is all around the fact that everything we're doing with our current bank account has to be the point where it's allowing us to do or service the business on a day-to-day basis. So if the things are going to start causing us problems, it's up to us. There is no substitute. It's us for taking control of that and making sure we're putting mitigating things in place. So your current bank account for your day-to-day running of what's going on in your business. The money that you've got, manage it. Sometimes people tell us they're too busy to track it, so they don't. Wow, this is the most important and vital thing that you've got. Uncomfortable to ask for money that's outstanding. Well, I get that, but put the right people in the right places to ensure the chasing gets done. When we look at people's current accounts and there's not quite as much in there as they envisage, it's because they're owed money and they're frightened to go and ask for it. So some people will quite happily not pay you. So you've got to get someone to hunt them down. Hunt them down as in, not you do this legally, of course. So we're looking to someone to use the phone, use whatever you need to do. We've got to have the right person in charge of credit control. Because if not, what's happening is you are cash flowing someone else's business and cash starving yours, or not only cash starving yours, potentially putting yours in jeopardy. So if you've got money owing, let's make sure we get it. Second bank account is your tax account. So a VAT, PAYE, and NI, and CT. So all of these things should be included. CT is corporation tax. So some people I know, when they get paid for things, will immediately take 20% off everything and put it straight into their tax account. Now, some people will work out what proportion of the revenues they need to put in their VAT account, i.e. we know that we pay 20% out, but on average over the quarter we get 6% of it back, so they'll put 14% in. Either or, it doesn't matter, so long as we're putting the money in. The ones that put 20% in, they usually cover themselves for the amount of money they need for PAYE, NI and corporation tax too. But have a separate tax account, because it's not your money. You are a collection agency for the government, for which they pay you zero, but it's not your money. The third one is a business reserve account for things that may or may not happen. So the business current account day to day, this one here, 10% of revenues or 3 months worth of cash that would allow your business to work if you have no incomes coming in, either or, it doesn't matter. It's there to cover you for things like, as it says there, fire, theft, flood, pandemics, digital ransom, which is becoming ever more popular, sadly, stakeholder bankruptcy, if people owe you, and you'll have seen people collapse and take other businesses down with them, and consequential loss, insurance exclusions, etc., etc. A business reserve account that has either 10% of revenues or up to 3 months worth of what you need to operate on a monthly basis. And the last one is your surplus profit account. Yes, this does exist as you start to build your business and you've covered your day-to-day, you've covered your tax, you've covered, you've got enough for any mitigating. Start to look at what you're going to do with the rest of it. So your surplus profit account, the advice that we would give you for both the surplus profit account and the business reserve account is to set those up such that you can transfer money into them, but set them up in such a way that the only way you can take money out of them is by physically having to go into the bank to sign a piece of paper. Yep. Set them up so you physically have to go into a bank to sign a piece of paper to move stuff out of your surplus profit account. And the reason we do that is because it's just too easy online to keep transferring money, and you think, oh, I'll just move some from my business reserve account. Well, actually, we should be doing something with our business rather than just putting money back. So yeah, put them into a transfer, but coming back, actually go in and sign it, because it makes it so much more difficult. So I think we're almost there. Let me just go down to the next slide. So this is almost complete. Financials, they do need managing, folks. I hope that what you've heard and seen this afternoon will give you some pointers, and you will do something differently when you go back. Most business owners do shy away from them. I go right back to the very start when we talked around the attrition rate of businesses in the UK. If we're starting today, in 5 years' time, 80% have gone. It's horrific, and it's because in lots of instances we don't understand what's going on because we shy away from understanding our numbers. And in the second 5 years, 80% of that 20% have gone, 4% survived till year 10. They are absolutely vital. I can't stress how important it is to actually know your numbers. And at the bottom there, as I said at the start, because it's a topic that lots of people like to work through practically to get the knowledge, we will be running a workshop at some point, and we will ping out details to everybody. So Boris has loosened the strings still further, and from Monday people will be allowed to go back indoors. So training events, etc., and one-to-one networking, no doubt, will all start back up again. So workshop with practical exercises will definitely follow. And just to finish, you know, what gets measured gets managed. If you measure these things, you will manage them. Once you start to manage them and understand that you are in control of your business, it will give you confidence. Not only will it give you confidence, it will, without a shadow of a doubt, reduce your stress levels about worrying what's happening. Even a 6-flow cash flow forecast that is not looking how you want it to do will ease your stress levels, because you'll know, you can see what is actually happening. Yes, we've still got to do something about it, but we've got the time and we've got the knowledge to know that we have to do something about it, rather than waiting for it to just be imposed upon us. We are actually starting to take control. So knowing your numbers in business is vital. Now, if you want to know them in any more depth, that's a completely separate workshop or a completely different webinar when we get into what we call financial mastery. That's for people that really, really do want to start digging down and understand what their business is telling them. At the level we've talked about today, it's sufficient for most SMEs or SME business owners. Having a handle on what's happening, vitally important. So that's good timing. It's 1:25. We have 5 minutes. So let's use the chat box for any questions that may be on there. I can't see the question box, so I think, Catherine, you're there. I don't know if any questions have come in. If not, please use the chat box now and put any questions in there that you may want to have answered.
Yes, so we've got, would you expect to get all of this information from your accountant?
Great question. The simple answer to that is it depends on what you pay them to do. If you're paying for them, as lots of business owners do, just for statutory compliance in producing their accounts, then no would be the answer. I would always advise speaking to your accountant to see what they offer, because most will offer the services, and lots of businesses will get quarterly management accounts, etc., to give them a better insight as to what's happening. But the basics you can do yourself. But yeah, it depends on what you pay them to do, I guess, ultimately.
Another question was, to do this yourself, do you need to have financial training?
Sorry, just repeat that question.
To do this yourself, do you need to have specialist financial training?
Can this be done without any financial training? Yes. Yeah, if you understand the basics, then yes, you can do that. If you look at the things that we've talked about, KPIs, simple cash flow forecasts, income, expenditure spreadsheets, etc., those things, the only reason we shy away from them is because we've never done them. It's much like when we start riding our bikes. We persevere because we know we need to do it and we want to do it. The reason we don't persevere in business is because we don't want to do it. But if we need to do it, then yes, those ones learned. If you want to get into deeper financials, then there is some training that would be required.
Can you give any examples of non-financial KPIs?
Non-financial KPIs, yeah, absolutely. So if you're looking at one of the value drivers for your business, one of them will be your customer score, net promoter score, and that's how people rank you. So you'd send out a satisfaction survey via a third party. I appreciate it's harder for smaller businesses, and you'd get something back saying that's what people think of you, and it's called a net promoter score. So it's not financial, it's just what people think about you. So that would be an example of a non-financial KPI. If I'm thinking about another one, it would be KPIs are a lot easier when they've got metrics associated with them, because we're looking at some kind of performance, but they don't all have to be financial. So number of one-to-ones with our direct reports completed every month. So we've got 10 direct reports. Have we done 10 one-to-ones every month? That's not a financial number, but it's certainly a key performance indicator, because I want people to make sure from a HR personal perspective, they feel as though they're valued. How do I see one question in the, how does a cash gap work with a service only business? Much different, and with the time remaining, I don't have time to go through that. It still exists. It does still exist, but nothing like the cash gap example that we've been through today. That is product-based, manufacturing-based cash gap, but it does still work there. So I can see who's put that question in. I'll have that debate separately, just purely from a time perspective, but it does still exist.
And then just the last one, John, was if we're doing this ourselves, how do we know we're getting it right?
If you're doing it yourself, how do you do it right? Ask your accountant, or if you've got a business coach that is financially savvy, ask either of those two people and they'll tell you whether you're doing it correctly.
That's everything from here. Thank you.
Okay. There's nothing else in the chat box that I can see. So bang on 1:30. Thank you everybody for joining us. Our next one is in 2 weeks' time. I think it's 2 weeks' time. Catherine, you might be able to tell me better than that.
It is exactly 2 weeks' time.
2 weeks' time. So, and it's also on numbers, but those numbers are about controlling and impacting your sales and ultimately profits. So that one, so I will sell that one actually, even though it's free of charge. It is the best webinar that we do, and it's something that all the businesses that we work with, large and small, they find it a real driver. So we're going to introduce you to 5 numbers that you really should be aware of in your business, and if you did something with them, the impact it would have. So highly recommend that for everybody. And anybody else you know that runs a business, if they're only going to jump on one of these 8 lunch and learns, get them on the next one. So if you need any help with any of that, as always, we offer a complimentary business review session. So if you want to do that, book that through the team. That would be great. We've got a calendar link on our website. This week's webinar has been recorded, as they all are, and the team will send it out to you in the not too distant future. So thank you all for attending this afternoon, and goodbye.